Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today is Thursday. It's June 14th, 2012. We're looking at the U.S. markets today, including the Dow Jones Industrial Average, NASDAQ, Russell 2000, and the S&P 500. We may look at the VIX as well. Right now, there's probably the last chance I have an opportunity to talk to you before Friday's market close. So this is what you need to know. Europe is the reason why the markets are being pulled down, at least the number one catalyst right now. We're looking at what happens this weekend in Greece as being a reason to see more selling, but it's also a possibility that you could see a short-term bounce to the upside. But here's the catch. What you have to realize about when you're looking at Greece, when this vote happens, is whether to stay in the euro or not. And if they choose not to stay in, which is the most unlikely choice for them, at least that's what everybody's telling you on Wall Street, that will be the most unlikely because they would have to then immediately go into some serious depression situation there. If they decide to stay in the euro, all they have to do is vote that way, and then they get to stay in the exact same boat they're in right now, which is not very good. Obviously, that's why it keeps coming back around. It's been going on for, what, 2 years now, and they keep getting worse and worse and coming back out for more bailouts. They keep getting them, and nothing actually changes. So when you see that, like Spain's debt levels jump up there to 7% today, those are unsustainable levels that basically bondholders are just looking at situations saying, look, you can finagle this, you can finagle that, but the end result will be a reality check where you have to go through a serious cut. You can do that by austerity, or you can do that by jumping out of the euro, and you can do it many different ways, but it's all going to end poorly for those who have gone way too far into debt. So that's the reality. If you get a vote to stay in from Greece, to stay in the euro, then you will probably see a short-term jump to the upside. But the reality is, this market top over here that happened on the Dow Jones Industrial Average had nothing to do with Greece. It actually has to do with the economics of Europe, the economics of China, and the economics here in the U.S. We are not in a situation that promotes growth right now, and that's why you're starting to see these markets topping out, and that makes a lot of sense to me. What I would suggest on this particular chart, some people are referring to this move here as being the formation of the first inverted shoulder. Then it comes up here, down to the head formation, and then maybe this is the start of the second shoulder formation here. A couple things you need to know about that. Number one, the first close of that start of the headline right there would be, or start of the neckline right there, would be right here to here, sloping down. Sloping down neckline in an inverted head and shoulders pattern does not support a very strong or bullish view of a reversal to the upside. It would be a very small rally. Also, something else to note, and this is the most important element in my opinion, the fact that when you're looking at a head and shoulders formation, it's important to get confirmation of the formation by volume, but it's not mandatory when you're looking at head and shoulders formation. When you're looking at an inverse head and shoulders pattern, it is required. When you get a breakout or close above that theoretical neckline like you've seen today, you'd want to see that move on substantial volume, confirming the breakout. Otherwise, you have a false breakout. It's something that people buy into, and then it falls apart. That's what we're seeing here, is a low volume rally out of that breakout there. So again, I wouldn't be a believer in that argument that they were seeing an inverse head and shoulders pattern. On top of that inverse head and shoulders pattern, as with a head and shoulders pattern, there's typically a trend established for a series of months. So not just a month, but a series of months, typically 3 to 6 months before you see the actual reversal pattern. So in a head and shoulders formation, you would be expecting to see a previous rally of 3 to 6 months, and then the formation of a head and shoulders pattern. In an inverse head and shoulders pattern, the same thing. It would be a downtrend for 3 to 6 months, and then the reversal. You don't have that. So again, that's more reason not to trust the argument that we're seeing an inverse head and shoulders pattern. Looking now at the NASDAQ, you can see a basic same overall picture. The inverse head and shoulders pattern people are looking at, or considering this to be an inverse head and shoulders pattern. Remember to use the highest close in these patterns. I can see the logic. You see the pattern on the chart, you think, oh, this must be an inverse head and shoulders pattern. But again, I would warn otherwise. They just don't have the volume to confirm it, and your neckline would be sloping from this point here and this point here, meaning it's a negative slope, and it's not going to be a strong rally to the upside. On top of that, any rally that you had on the upside here would only create a bearish divergence formation, bearish setup basically. And it's not something that is sustainable. It basically tells you that the rally will be unsustainable and will collapse. So if we were to get any bullish news out of Europe, something like that, it won't even be bullish, but it would just be that they're going to stay in the euro, then you could see a move to the upside. That move to the upside would give you a shorting opportunity. Remember, any move in price activity in this direction is going to send the ultimate oscillator up in this direction as well. It doesn't have very far to go before it gets up into the 70 overbought condition like you've seen back here. The problem that you would have here isn't necessarily that you're short-term overbought. The problem I would have with this fact that you'd have a higher series of highs here and here would be trending up like this, and yet your corresponding time period on the price activity would be a high close here, and then your other close would be nowhere near that proper level. Your close would need to be way up in this range for it to actually follow and be confirmed by what you're seeing in the ultimate oscillator at that time. So any rally to the upside would, of course, not be something I want to buy into. On top of that, even if you have a different view on the markets or whatever, you'd still look at this market and have to realize that we're not even seeing a series of higher highs here. So what we have is this move to the downside, upside, downside, upside, downside, upside, downside. We're seeing lower series of lows, lower series of highs consistently. You're not seeing any reason to be a buyer here. Zero, zilch, nada. You must have at least 4 points to alter a downtrend to an uptrend, and those 4 points require a series of higher highs like that, and then you would have higher highs, and then a pullback which would give you confirmation of lower lows. Higher lows. That would give you 4 points that you could argue that's a bullish situation. I'd want to buy this pullback and keep a stop off of this point. That would make sense. But right now you don't even have that. So there's no reason to be a buyer out here. If you're holding stocks going into the weekend, I would only do so on the short side with a tight stop. I would not be attempting to go long this market because there's nothing there to buy. There's no chart telling you to buy it. So why would you do that? The Russell 2000 Small Cap Index, same overall basic story. So we were looking at this again as the inverted head and shoulders pattern here, 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 and here. That makes an argument that I understand why they're doing that, but they're doing it based solely on the chart's pattern, and they're not looking at what actually makes the inverse head and shoulders pattern work. And that is, again, volume confirmation, which you don't have, trend line formation, as well as the duration of the sell-off prior to the bottom. All these things have to be in play. And again, if you look at the fundamentals, you can say, wait a minute, we don't really have any reason to rally. Our markets are just getting worse. Our economy is getting worse. We had 69,000 jobs last May. These are not good things, okay? Look at China, so forth and so on. Again, the main thing to point out here, of course, is the neckline on the previous head and shoulders formation, which you had back here. We talked about it was just forming. You had several months of a rally. Then you had the formation of the head and shoulders pattern, which you can't see all of it right now, but here's what's left of the head, and here was the shoulder, and the close below that neckline confirmed that, and then you've sold off from that point, bounce up, found previous support, now acting as resistance, you sold off from it again, you bounce up, hit it again, find resistance again, sell off again. There's no reason to be a buyer of this market. Lower lows, lower highs, don't touch it. Looking now at the SPX, or the S&P 500 Large Cap Index, you can see the same overall story is in play here. You had a previous move to the upside here, sold off, failed at the previous test of the high, and broke down. That's a very, very, very bearish signal here. And now we're starting to get this little move here that people are looking at as being a possible inverse head and shoulders pattern. Again, I don't like it for the same reason we've already discussed with the others. No volume confirmation here. Nothing, not enough time is built into this down sell-off to form the inverse head and shoulders, not properly, not a strong one. On top of that, again, we have the same thing we talked about before. Back here, we told you had a bearish divergence formation right here, a bearish setup. You had the ultimate oscillator trending higher, and price was not confirming it was trending lower. That tells you that this rally here is false, going to fail. It does. In this situation here, let me clean that up so you can see it a little bit better. I don't know if that helped any, but let's try that. You can look at the close. The highest close point was here. The next highest close point was here. Downtrend like this. And you look up here, high point, lower high. It's doing this. All right. Again, it's forming another one of these. Rally to the upside. You're going to get the same situation you had before. I showed you on the other chart. You're going to have this guy move up here above the 70 line, and then you're going to have to look at this previous high point here, a higher high here. It's going to be trending up like this. You're going to be looking at this corresponding high close and say, wait a minute, this is not confirmed. It's all going to be erased. So even if you get not as bad as could be expected out of Greece, you're still only going to get a short-term rally to the upside, which give you a short opportunity and see the whole thing collapse again anyway. So, nothing to do there but watch the markets. If you've not been to our free website at perfectstockalert.com, it's right there. It's 100% free, and all we ask in return, please prefer a monkey. God bless. Take care. See you tomorrow. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.